Hey, this is Jussi. I run an investment firm that specializes in REIT investing, and overall I've been quite successful at it. I've managed to generate roughly 2 times higher total returns than Vanguard Real Estate ETF and about 4 times higher returns than the MSCI REIT index. I'll put some chart on the screen so you can see the difference in performance, but this doesn't mean that all my investments have been successful. On the contrary, I've had my fair share of losses. I take risks to earn returns, and at times the risk factors play out, and then at other times I just make mistakes and I end up paying the consequences. In today's video, I'm gonna talk to you about my biggest loser of all time, but before I get into it, could you please make me a big favor and like this video? Help me a lot. Thanks a lot. So my worst REIT investment of all time is a company called CBL Associates Properties. Its ticker symbol is CBL. I used to own a position in its preferred equity, but this preferred equity was later converted into common equity following its debt restructuring, and this led to a roughly 90% loss on my invested capital. What went wrong and what can we learn from this? Let's first talk about the bull case for CBL back in the days. So CBL was your typical cigar-butt type investment. It owned low quality assets. We knew this really well, but it was priced at such a low valuation that it caught my attention. CBL is a mall REIT, just like Simon Property Group, but unlike Simon Property, which invests in Class A malls in primary market, CBL would invest in Class B or even Class C malls in secondary markets. So understandably, the market was really concerned about the future of CBL's properties. It feared that in a day and age of same-day free shipping, there was probably not a bright future for Class B malls. Amazon and other e-commerce players were growing really rapidly, and this was causing great pain to CBL. As a result, the market priced the company at a really high dividend yield in excess of 10%, and it also appeared to trade at a really large discount to its net asset value. I thought that the risk-to-reward of the company was really compelling because of several reasons. For one, the payout ratio was only about 50%, despite providing an over 10% dividend yield. For two, the properties were still growing their sales per square foot despite all the negative headlines of retail apocalypse. For three, the malls, despite being of lower quality, they were market dominant in their smaller secondary markets, and I thought that this would mitigate risks because it was not economically feasible to build Class A malls there, and so in a sense they had a quasi-monopoly in their local markets. Then for fourth, its malls were rapidly evolving into mixed-use destinations, and there was an opportunity to recapture the place of anchor tenants such as department stores like Sears, Macy's, and then to redevelop this into other uses to capture much higher rents. And then finally, we thought that the company was priced at a very low valuation relative to its historic average, and we thought that as the company gradually redeveloped its assets, improved their quality, we would see a shift in the market narrative and a repricing to a higher valuation. While you wait, you would earn a high dividend yield, and so overall the risk reward was very compelling to me. And yet, despite all of this, I lost over 90% on this investment. So what did I miss? I really made one major mistake here. I underestimated the leverage of the company because I overlooked the impact of capex on its payout ratio and its financial flexibility. I thought that the dividend of the company was safe because the dividend payout ratio was around 50%. But adjusted for capex, the dividend was actually really poorly covered and the leverage of the company was excessive relative to its free cash flow. Most of the capex went into improving the quality of its properties, and so this led me to think that some of this capex would be optional and that the company would simply be able to stop spending all of it if it wanted to. But that's where I was wrong. In reality, most of this capex was crucial to the company, not just for its future growth, but also for its survival, because in many cases, the REIT might have lost a big tenant at the mall and then it had to reinvest in the property to make it attractive to new tenants. But if it stopped spending this capex, the mall could rapidly fall into a death spiral with one tenant vacating, causing another one to vacate, and then another one, and eventually we reach a point where the mall just cannot recover from there. The consequence of all this capex is that the company's balance sheet was too weak, and this was really made clear when the pandemic hit the company. Tenants started to skip their rent payments. This rapidly led to a full elimination of the dividend and an eventual bankruptcy filing of the company. What are the lessons here? There are really 3 of them. The lesson number one is that capex shouldn't be underestimated. It really has a major impact on the financial flexibility of the company as well as its leverage and payout ratios. Not all capex is optional, and clearly in the case of CBL, it was vital to its survival. This reminds me of a lot of office REITs today. I think that investors are greatly underestimating the impact of capex, and so they think that these REITs have strong balance sheets, that they have great financial flexibility, but if you take into account all the capex that these REITs are going to have to reinvest in their buildings, in many cases these REITs actually become dangerously over-leveraged. Then the lesson number two is that leverage is really the main killer in real estate. As long as you own decent properties and you have even average management, it's very hard to lose money in real estate in the long run unless you're heavily leveraged. And I think it's Charlie Munger who has famously said that smart people lose money only in three ways, and it's leverage, liquor, and ladies. And what he means by this really is the leverage. That's the most important one. If you over leverage even good assets, you might lose it all in the long run. And then finally, the lesson number three here is that payout ratios can be very deceiving. Today, most REIT investors look at payout ratios based on FFO, which stands for funds from operations. It's supposed to be a representation of the cash flow of the company. And so in many cases, you might have, as an example, an office REIT with a 50% payout ratio. And so people will assume that the dividend is safe since it's covered twice by the FFO. But what they forget here is that FFO typically does not include the impact of capex. That would be the AFFO, which stands for adjusted funds for operation. And in a lot of these property sectors like malls or offices today, the need for capex is growing rapidly, and so even in a case with a 50% payout ratio based on FFO, you might have actually a dividend that's very poorly covered once you include the impact of capex. For this reason, I actually expect a lot of office REITs to keep cutting their dividends in the coming years. The bottom line here is that I could have probably avoided this loss had I paid more attention to the capex, its impact on the leverage of the company, and its financial flexibility. But I had to suffer this loss to learn this lesson. Hopefully you don't have to suffer the same financial loss you can learn through my video here. And in a sense, I'm actually glad that this happened years ago, because this allowed me to avoid investing in office REITs towards the end of 2021, when a lot of people were claiming that they were undervalued. Since then, most office REITs have dropped by 50% or even more than that. And so in a sense, it was a good thing I suffered these losses with CBL back when my portfolio was small in size, because the losses will have been much greater today. Now, what's your worst performer of all time? Please let me know in the comment section below. And otherwise, if you want to learn more about what I'm buying at the moment, feel free to join my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link in the description below. And otherwise, again, if you can like this video, please subscribe. Thank you very much. Bye bye.